Now we're going to fill up the adjustment in here, okay? Now we're talking about income, right? Now if let's say this is a taxable income, or let's say this is a non-taxable income, so what we need to do the adjustment when we prepare tax computation. Alright, now we talk about adjustment in the tax computation. First of all, I think let me just give you an example for profit statement first, okay? Alright, now let's say this is the income statement. Now class, normally before we prepare the tax computation, the company must prepare the account first, correct? Okay, they must have an income statement. Now and then usually they start from the sales, and then they will have a minus the cost of sales, and then they get the gross profit, okay? And then here they will add other income. Okay, now let's say class, I have two income in here. Let's say one of the income is compensation. Compensation for, let's take an example just now. Remember the example for the loss, compensation for loss of machine, and also the compensation for general damage. Okay, we take that example. Okay, let's say I have these two compensation. So one of the compensation is for the machine, 1.1 million, right? And then another compensation is for the general damage. Okay, and then this is 50,000, right? Okay, so 50K. So now class, let's assume these are the two other income that recorded into the company accounts. So, and then at the end, you will minus expenses, and then you will get net profit before tax. Am I right? Okay, for tax computation, I open up another new page. Tax computation, can you go back to your computation form, your chargeable income format? To calculate the tax, at first we must calculate the chargeable income. So the chargeable income, you can start either from gross income or either from what? Profit before tax. Yes, usually we will start from profit before tax. Okay. Now let's say, just now in the page here, let's say my net profit is include everything already. My net profit is, let's say 200,000. Okay, so now class, in our computation we will start from this figure, 200,000 profit before tax. And then for the income, we don't talk about expenses yet. Expenses is in your chapter 5, right? So now we concentrate on income. In your profit statement just now, is it actually you have two other income in here? Actually you have one more income, is the sales. Okay, let's say the sales, everything is related to business, then no issue. But come to this other income, you have two compensation income in here. One is actually capital income, another one is trading income, revenue, correct? So which one is taxable, which one is not taxable? You can tell me the figure, 1.1 million, taxable or not taxable? Why? Because? Yes, capital income. Alright, so this one not taxable. How about the 50,000? Yes, because it's a revenue income. Alright, so you already determine whether is it taxable or not taxable. Then only you go back to this tax computation. Okay, now class, after profit before tax, normally we must have adjustment. Okay, your adjustment, let me just give you the adjustment that related to our example here. Okay, for any non-adjusted income, not taxable income. Okay, refer back to here. 1.1 million is actually not taxable, but you already included in your profit and loss, correct? So if let's say this is not taxable, usually for tax computation we will take it out. Alright, so let's say you take out this 1.1 million, what will affect your profit here? Your profit will go down or going up? when I take out the income of 1.1 million, because not taxable, correct? So I will take it out. So and then my profit will be go down, reduce, correct? So in here, our adjustment should be yes, minus 1.1 million. Understand? Right? Then another one. Another one is 50,000. This 50,000 is taxable, and the amount is already added to the profit already, okay, into your P&L already. So this 50,000 since already add into your profit, and then also they say it's taxable. So what we need to do?
No adjustment.
Still need to add.
No adjustment.
Class, I already mentioned this 50,000, is it already included in this profit? Yes, because already inside your profit and loss, correct? This 50,000 is already appear in the profit, you know. So if let's say they say this is also taxable, then what you need to do on your profit? No need to do any adjustment. Remember just now I said the adjustment usually you have three, correct? Yes. Add, minus, or no adjustment. So that's why this one is taxable, already included, no adjustment needed. Boleh faham? Alright, so that's why this one no need to do any adjustment. So class, if you go back to the notes here. Okay, now we need to fill up the figure. Okay, now so if let's say we fill up this column first, before profit, before the profit before tax, which means they already included the item into your income statement. Like example in here just now. Before profit before tax, this is the amount before the profit before tax, right? Yes. Okay, before, which means already included. Okay, so when this item already included in your P&L, so the first one, if this is a taxable income, so what is your adjustment? No adjustment. Okay. Okay, then what if let's say this is a non-taxable income but already included in your income statement? Yes, you minus less. Okay, So that's why you can see that in my example just now, I only minus the 1.1 million. Okay, right? So this is the adjustment. Now another example, another scenario. Now what if let's say this is the income statement I gave you, and then sales minus cost of sales. Alright, that is a gross profit in here. Let's say 300,000. Okay, and then they didn't add on other income. They straight away minus the expenses. Expenses here, let's say 100,000. Let's say 200,000. Then the profit before tax, 100,000. Okay. Now then only they give you a note. That is a compensation. Same example, right? That is compensation for 1.1 million and also the 50,000, but they're never included into the P&L, right? That is also sometimes there is a scenario. So this is a non-taxable income 1.1 million and also 50,000 taxable income. Both also didn't record into your P&L, so didn't included in the profit. So now class, what will be our adjustment? So normally I will prepare a tax computation again. And then my tax computation will be again start from profit before tax. Am I right? So just now my profit before tax is 100,000. So later on we need to have some adjustment. Okay, got two income never record into the profit and loss. Didn't include in this profit amount. So non-taxable income 1.1 million. Should I need to do any adjustment? Not taxable, not included in the profit and loss also, correct? So no need to do anything. Get what I mean? Alright? So because this income is not going to be taxed, so no need to include also in the profit actually. Okay, so since they didn't include, no adjustment needed. But how about the 50,000? 50,000 is actually a taxable income subject to tax, but they never included in this profit amount. So we need to add on again. Am I right? So that's why your adjustment here now will be at 50,000. The compensation on the general damage. So far, so good. You must know the adjustment very well, right? So that's why I give you this basic explanation first. Of course, when you come to the exam, when you answer the question, don't draw all this thing again. You must just come in your mind whether add, minus or no adjustment. Boleh faham? Right? So let's fill up the table again. Okay, now class, another column in here. This means after PBT. So can you see that actually just now the compensation information is actually after the PBT. After the PBT only I give you a note, right? That's why they didn't include it in the P&L. Okay? So after the profit before tax, or actually not included in the P&L. So let's fill up what adjustment here. Yes. Okay. So class, how should we fill in here? Taxable income but never included in P&L. Yes, we have to add. Not taxable income, never included in P&L. Yes, then no need to do anything also, right? No adjustment. Alright, so done. So we already talked about the adjustment for income. Okay, so let's continue. Now give you some example of the general income that you will see in a business. Okay, this is the first one, insurance recoveries. Now insurance recoveries means that insurance claim. Now class, tell me first, normally what are the insurance that were purchased by a business? Medical insurance for staff. Okay, fire insurance. Yes, to cover the stock, right? Or maybe those that asset. Okay, let's say any the fire happened, everything gone. Other than that, robbery, burglary insurance. Okay, and then also what else? Machinery damage. Alright, insurance to cover on the asset. Okay. Other than that? Employees, medical insurance, life insurance, accident insurance. Correct? Alright, then I think you know that there is a lot of different type of insurance. Okay. Now, but class, before you can claim, get back the insurance recovery, you must actually buy the insurance first. Correct? And you must pay the premium first. Am I right? So expenses come first. Alright, then maybe in future, really anything happen, then you will get back money. That is your income already, right? Recoveries. So now class, I give you a summary notes here. You copy down this one. So this is for you to understand about the insurance recovery here. Okay, this is a summary. Take down first. Okay, now class, as I mentioned just now, if you want to get the recovery from the insurance, first of all, you must pay the premium first to buy the insurance first. So we will see the expenses in here. Alright, the premium that you pay, right? If let's say this is the insurance related to accidental, right? Your staff personal accidents insurance, okay, so those the fire insurance, accidents and so on, all this will be actually deductible, right? And of course, class, when they allow you to claim expenses, then in future when you get back insurance claim, they will also charge you for tax, okay? So when the expenses is deductible, then of course income is taxable. Just remember this concept, okay? Now next, second thing is the terms insurance. Now terms insurance is some kinds like you can say like general insurance also based on the terms policy. So general is on those group insurance, right? So for the employees and so on. So and this one will be also deductible premium, and then the recovery will be also taxable. Now, but what actually is not deductible and not taxable is actually on these last two things here. Endowment policy is usually referred to life insurance also, but they are with the investment element. Right? Nowadays you see that a lot of insurance that will sell you with like investment linked plan, okay? Which means some of your premium amount they will put it into a unit trust or investment that will generate a little bit of the cash value for you, right? That is some kind like endowment insurance, right? Okay, and then so that's why this one is actually include life element, so and also investment element. So the premium that you pay is not deductible for tax purpose. Okay, and when this is not deductible, income will be also not taxable. Okay, so the life insurance you buy for your staff and so on actually is not deductible one. So another one is purely on life insurance, no investment element. So of course this one also not deductible and income not taxable. So you should know that actually when you get all this recovery, like if you buy life insurance on certain person, you will actually get the claim once the person die, correct? Pass away. If you actually buy a fire insurance, then it must be actually happen. The fire happen, then only you can get the claim. If let's say you buy burglary insurance, then you must actually claim it whenever you have a thief and then you suffer in a loss. Okay, so that's why you must understand all these things. But of course, you don't need to understand like in very details. Okay, what type of insurance and so on. General information you must know. Okay. All right. So this is a basic concept. Now you refer back to your notes. They give you some example. Okay, now by the way class, some of the recoveries that included in the gross income for you to cover the loss of the profit, or is for the claim to repair to the business premises, or is the claim that to cover the defalcations by employee. Defalcation means the employee, you can say that steal your money, right? Defalcation by the employee, which means the staff misuse your money, steal your money. And also from any thief, right? Or maybe of the trading stock. So all this, the recovery on all this will be taxable. Okay? So all this will be taxable. Then of course the insurance you buy for cover all these things will be also deductible. Okay? Right, now next. Now we're going to talk about doubtful debts or bad debts already. Again, now we talk about income, okay? So we are talking about the recovery of bad debts. And I think class, you know what it means by bad debts, right? And how about doubtful debts? What is the difference between doubtful debts and bad debts? Bad debts confirm cannot collect. Doubtful? Maybe. Provision, right? Yes, that is the difference. Alright, since you understand about that, again, give you a summary about the recovery of doubtful or bad debts. But class, again, the same thing. Recovery for bad debts is the income, right? So at first, is it you must happen a bad debt first, then in future only you might recover back, become an income, correct? So we will also talk about expenses in here. So the bad debts amount, bad debts expenses, and also the bad debts recovery. So this is again a summary. Okay, so again, some when there is expenses incurred, right, for bad debts, so you have to determine the deductibility of the expenses first. Then only you will know that the income, the recovery in future, whether will be taxable or not taxable. First one, the bad debts, confirm bad debts, yeah. But can you see I mentioned in bracket about trade? Trade means related to business, right? Trade means related to business. So if let's say the bad debts is related to your business, which means your customer bad debts, example, right? So definitely these expenses will be deductible, right? Bad debt expenses is deductible. And let's say in future, this person come back and want to pay you back. So you recover the money, right? So then the recovery will be also taxable, okay? Expenses deductible, income will be taxable. Expenses not deductible at first, then in future you collect the income, also not taxable. Okay, that will be fair enough, yeah? Right? Now second one is actually bad debts again also, but can you see in bracket, I mentioned non-trade. Non-trade means not related to business. What is the example that not related to business? Lend money to friends. Alright, yes, you can say so. You lend the money to an outsider, right? The company maybe have some money, so director say that, okay, I want to borrow the money to one of the friends or whatever, right? So this recorded into the company accounts as a loan, short loan, right? Lended to someone else. But subsequently, let's say this individual cannot pay back. Is it a bad debt also? But this is a bad debt related to your business? No. Then of course these expenses deductible. And then in future, if you recover back, if the company recover back the money, also not taxable. Now next, let's talk about provision. All right, provisions for doubtful debt. This which means it's not confirmed yet, right? It's a possibility that. Now, but class, you have two categories here: general provision and specific provision. What is the difference between general provision and specific provision? This one you studied in accounting before, right? So apa bezanya? The wording different. General and specific. What else? Specific is a better. The worst one. Then means. Are you sure? Specific, alright. Specific is worse compared to general. Okay. Acceptable lah. Lagi ada apa point? But this is not my main point. Need to call. Which one? Specific one. Alright, yes, one of the points. General is actually based on the overall percentage usually. Am I right? Maybe you get the percentage of sales, percentage of the debt outstanding, then you just make a provision estimation that maybe the debts that cannot collect back. Am I right? But specific means that you actually estimate the debts cannot be collected back on a specific individual or specific customer. Correct? Alright, and definitely class, when you actually make this provision on the specific debtor, you must have reason. Correct? Maybe, example, alright, you heard that this individual already facing a court case. Alright, but don't know what is the outcome from the court case yet. Maybe this individual is going to pay a lump sum amount of the compensation after the court case. Subsequently, if let's say they're really subject to a huge compensation amount, then I think maybe he will go for bankrupt already lah. Then subsequently, cannot pay me back. Correct not? But can you say that now is confirmed already? No, but high chance, right? Then we will make a specific provision. Correct not? Alright, and then class, in this situation, for income tax purpose, specific provision that will allow you for deduction. Okay, the provision amount you can you will allow for the deductible. But of course, in future, let's say this bad debtor that were willing to pay you back the money, the recovery will be also taxable. Okay, but general provision, your estimation only. We don't know who is that also. General percentage. So the concept here is estimation is not allowed for deduction. Okay, not deductible for general provision. Then of course, the if let's say this is an income for general provision, it is also not taxable. Okay. Now class, I think you studied before that in your accounting subject when there is a general provision or specific provision, you might actually incur either expenses or income in your profit and loss. Correct? When there is a increase in provision, equals to expenses. Correct? It's a bad news, right? But if let's say there is a decrease in provision, it will become an income? Because it's a good news. Alright? So now I give you an example. Let's try something here. Give me a minute, right? I give you a few examples for you to try. Alright, it's okay. I think the example I gave it to you on when we study about chapter 5, right? Because chapter 5 also we have a bad debts topic. So you look at your tutorial notes example. Alright, you can also use this example, right, for your better understanding. So now this company write off 2,700 being the trade debt of NJQ who has passed away already for the year ending 30th September 2018. So bad debts written off. Now during the same year, the company received 2,000 from NJR whose the trade debts had been written off and allowed for tax purpose in 3 years ago because he could not then be contacted. So 3 years ago, NJR already missing, right? The company cannot contact him. So that's why 3 years ago already write off as a bad debts. But 3 years later now, right? This NJR come back and pay the company, right? For the debts. Is it this is a bad debts recover? Yes. Alright, next. Then now they tell you about the solution. So class, the 2,700 that written off as a bad debts is allowable as a deduction. First of all, this 2,700 is expenses, yeah? And why this expenses is deductible? If you refer back just to the example given just now, can you see they mention the key word? Being the trade debts, alright? Any debts related to trade, deductible. Related to non-trade, not deductible, alright? That's why now the solution they said is allowable as a deduction. Okay, 2,700 is allowable. And another 2,000 is actually recover back. Okay, recover back from the NJR. NJR, is it a trade debt or non-trade debt? You must refer back to the question. If let's say this is non-trade, right? Not taxable. If this is a trade debt, then the recovery is taxable. Okay, trade debt, right? Yes, and that's why here they say that the recovery of the 2,000 is taxable. Then after that, they give you adjustment. Alright? Now so class, if both of these amount also shown in your profit and loss account for the year ending 30th September 2018, if both of the amount also already included in P&L. So far you study about income, right? Okay, then we just look at income first. The 2,000 recovery, is it taxable income? If let's say this is already included, your adjustment will be no adjustment, alright? And that is why they say that no adjustment is required in the tax computation, okay? But what if let's say the recovery for the 2,000 is not entered into the P&L? Add or minus? Then you need to add, right? Because this is a taxable income, but if let's say you didn't record into your profit and loss, then an adjustment for that amount should be made in the tax computation. They didn't mention to you add or minus, right? Please remark yourself. Add, alright? You must add back to this. Okay? So add to your computation the 2,000. Okay, next. Alright, now class. Next part, just now we talked about the bad debts is related to customer, correct? Now let's talk about the debt by the creditor that we owing to the creditor. Okay. Now sometimes the creditor might be waive the debts, right? For a certain customer example. So waiver of the debts by the creditor means that actually you're owing to your creditor, but then they don't want they no need you to pay anymore. So waive the amount already. Okay. So in this situation, for the company, let's say class, I am a company A, and then I get a waiver from my creditor. Supposingly, I owing to this creditor 10,000. Subsequently, they say, never mind, this amount waive, right? You no need to pay it already. So what will happen to my company? Is it an income? Yes, it's an income. So now you look at this section. The section 30 sub 4 provide that the waiver of the debt by the creditor, which pertaining to any amount of the expenditure previously allowed as a deduction in ascertaining the adjusted income, then will be also regarded as a gross income, means taxable, right? Please remark yourself, taxable. But of course, yeah, class, When you're owing to your creditor, right, which means you already record something into your P&L before. Normally, why you were owing to your creditor? Because of purchase? Because of expenses? Correct. So all those purchase and expenses will be recorded before in your P&L already. Get what I mean? So if those expenses is already deductible, then of course now the income will be taxable. Okay? But if let's say class, that is the expenses that previously not deductible, then the income now, what will you think? If this is a creditor I owing because I spend the expenses, but these expenses not deductible, then now the creditor say, this amount waive, is my income already. Will I be taxable? No. Concept fair enough, right? If the expenses not deductible, income not taxable. If the expenses deductible, income will be also taxable. Okay? Fair enough, yeah? That's why here they say something. If this is an expenditure previously allowed, okay, as a deduction, then only the income now will be regarded as a gross income, then will be taxable. If previously not allowed for deduction, then now also not taxable. Okay, remark anything that you think is important. Then now we continue to drawing of stock. Okay, now class, drawing of stock. I think you understand what is that, right? When the company stock or product taken out for certain purpose, that is considered drawing of stock. Now, but normally if there is a drawing of stock, right, the company won't record anything to the accounting transaction. They will only adjust the stock out, right? So, but for this kind of stock, you won't have any sales, correct? Because this is a drawing, okay? No sales you will record into your accounts. Now, but for income tax purpose, right, we will see that what is actually your purpose. You withdraw out the stock. Now, first of all, if let's say this is the stock withdrawn for own use, which means for office use, okay, then the market value will be still considered as your gross income. Let's say, I give you example. Now this one, I have some example in here. Okay, you copy this first. Let's say this is a manufacturing company. Okay, now class, this is an example whereby the company is a manufacturing company. They manufacture furniture. Now and then normally when they manufacture the products already, they will include the cost, right, in their accounts. So now this is the cost amount for this 3 unit of the furniture, 100,000. So subsequently, these 3 unit of the furniture taken up by the company for office use. Maybe like let's say the table, right? So or maybe like a certain furniture like cabinets and so on. So office will need to use that also. So the cost already included, right? Cost already included in cost of sales. Now and then now you take out for the office use. Definitely the sales will be 0, correct? So but actually these 3 as furniture, they have a market value of 150,000. If you didn't take it for your own use, you can sell it for 150,000 actually. So income tax will say that, alright, you take out for your own use, so you didn't record anything as your sales, no income for this 3 unit, correct? But I don't accept. I want you to still trade it, this 3 unit of the furniture, charged as a market value, right? So which means that you cannot record your income as 0 for this 3 unit. You must record this the income for this 3 unit for 150,000 according to the market value. Understand? Right? Actually, company didn't pay any amount for that, right? This is in actual situation, but income tax don't accept. So they will say that even though you withdraw for your own use, you still need to charge for market value. Understand? Okay? So we need to do some adjustment in your tax computation. So I just give you a draft tax computation in here. Now normally we will start from the profit before tax. Now let's assume there's a certain amount here. Now after profit before tax, we will need to do adjustment, either add, minus, or no adjustment. Then class, try to think on your own first. What will be the adjustment here? In your accounts, you didn't record the sales for this 3 unit because company use it for office purpose, correct? But income tax said, no, I don't accept. Even though you withdraw out, you still need to charge for market value. So then what will be your adjustment? Add. Anyone will say minus? Minus 100. Anyone will say no adjustment? Okay, I'll give you 1 minute. Think about it properly. In your accounts, you included the 100,000 cost, but you never record any sales because you withdraw out already, right? But income tax say no, you must still have an income based on the market value, right? The withdrawal must be still subject to market value as your income. Same concept class. Now you need to think about that whether the market value must be considered as a taxable income or not. And if let's say yes, whether is it included in the P&L or not. Included and not included, you will have a different adjustment, correct? According to the table just now. Same concept. So class, now that mentioned here, for the stock that you withdraw for own use, right? Market value must be still treated as a gross income, correct? Okay, first question means that this is a taxable income or non-taxable income? Taxable income, right? First thing you determine taxable income. Second, this income included in P&L or not? No, because you withdraw out, you never record as sales, correct? Okay, yes, second thing, not included in P&L. Third, adjustment.
Yes, add back.
Add. Yes, class, you must add back, right? So you have to add stock withdrawn. Okay, and must be based on the market value. So you were going to add how much here? Yes, 150,000. So this will be the adjustment in your tax computation. Okay. The cost that already included in the cost of sales, right? No need to do any adjustment because now I charge you income already, right? Then definitely your cost will be also deductible, right? Already included in the cost of sales. No need to do anything. Okay. Another example. Okay, now class, second example, take down the same thing again, but now they say that the cost is not included in cost of sales. Usually our adjustment will be depends on what the company record in the P&L, yeah? Right? Then only we make the adjustment accordingly. So now the second example. So now class, this example is actually the same, but only the things different is that the cost, right, for this 3 unit, the 100,000, they didn't include it in the cost of sales. Okay, let's resolve one by one, right? Now class, for income first, this 3 unit again is taken out for the office use, okay? And then the income market value is supposed to be 150,000. According to the tax rules, they still say that market value will be considered as a taxable income, alright? So you will have a same adjustment in here. First of all, you will actually add the 150,000. Alright, market value still traded as your gross income. Alright, so you need to add 150,000. Then only we go and solve the cost part. Alright, now class, since I charge you income already, and definitely the expenses that you incur for this income must be also deductible, correct? Previously, because the cost already recorded into the cost of sales, already deduct the profit. But second situation now, do you include the cost into your cost of sales? No, right? So which means the cost is expenses, right? Alright, expenditure, not included in the P&L, but it is deductible. Okay, so then what should you do for the adjustment? Add or minus or no adjustment? Minus, right? Because this is allowed for deduction, right? Okay, so another adjustment in here, you have to minus. Because previously the cost is already included, so you didn't do any adjustment. But now this cost didn't included, then you must do the adjustment whereby to minus the cost of the furniture. For that 3 unit. So you minus how much? Yes, 100,000. Okay, so this will be your adjustment. So actually class, for this 3 unit of the furniture, right, is it you were able to generate 50,000 profit? Correct or not? Market value 150, cost is 100,000. Indirectly to say profit is 50,000. So you can have another option also. Maybe you don't want to mention here add and minus. I can also write the adjustment here as add profit from the stock withdrawn 50,000. Will you get the same answer?
Yes.
Yes, because the net amount from here is 50,000.
Yes.
Yes, that is another choice. Okay, so it's up to you whether you want to record like this, add 150 and then minus 100. Alright, or you can also straight away add 50, the profit. Okay, so this is a choice. Alright, so go back to your notes again. Class, any stock withdrawn for own use, the stock withdrawn for a consideration. Consideration means payment. Okay, so maybe I will use my stock to consider as a payment to you. I have no cash money. Alright, so that is consideration purpose. Or maybe withdrawn for a debt. Okay, or maybe you withdrawn as a gift or you throw it away. Alright, all this also for what? Market value will be treated as gross income. Alright, all this having the same treatment. Yeah. Alright, so now class, look at this example. Furniture, cost amount 24,700, donated to approved orphanage home. The selling price is actually 26,000. A set of the bedroom furniture 6,004 and then sold to the staff at 5% discount. The selling price is actually 7,000. Right? Okay, cost amount is 6,004, selling price is 7,000, but give 5% discount to staff. Now, question is actually just want to ask about the drawing of the stock, right? So whether the income will be chargeable for tax or not. So look at the solution. Now, first of all, the stock you take out and then you donate to an orphanage home, right? Okay, refer back to the note just now. What they said. This one will be falls under which category?
As a gift.
Yes, as a gift, right? Again, what they said here? Market value will be treated as a gross income again, so will be taxable income. So you see, they will say that the trading stock disposed by the way of donation is not in the normal course of the business. So that's why it is deemed to have disposed at a market value. Therefore, add back 26,000. Alright, just now the market value is 26, right? Alright, you add back 26. But how about another one? It's the furniture you sold out to your staff, but at a special discount. This one actually is not considered as a withdrawal, right? It's a very normal situation in the business. Am I right? Alright, so that's why they say the sale of the furniture to the staff member is a normal incident of the trade and therefore no adjustment needed. Okay, why actually withdrawal of the stock we will normally add back? Because like just now they already said this is not in the normal course of the business. Is it this is compulsory to take out the stock for your donation purpose? No, right? Right? But is it actually it's very normal that if you give a discount for your customer, even though that is a staff, that is normal, right? That's why that will be actually deductible. So no adjustment needed. Okay? Then you can see one more example here. Telecommunication equipment. Now class, 3 units of the telecommunication equipment, like the phone, right? From the opening stock were transferred to fixed asset. What is that means? From the stock, you transfer to fixed asset. For office use, correct? Not? Because for office use means become fixed asset already. Okay, so now this is for office use. So the cost price for this 3 unit is actually 80,000, but normal selling price is 96,000. So solution? Add back 96,000 market value, right? Again, this is for own use, for office use. So add back 96,000. Okay, last example to go. When they say the cost of sales is arrived after crediting 40,000 in respect of the cost of the goods manufactured by the company, which subsequently withdrawn for the use as a fixed asset, right? So which means actually this company now taking their stock for the office use, right? Fixed asset already, and then they actually credit up the 40,000 from the cost of sales. Now plus, cost of sales amount supposedly should be in debit side, right? But when now you credit 40,000, means that the cost taken out from the cost of sales. So you didn't included the 40,000 in the P&L anymore. Get what I mean? Right? And further, this asset actually worth for 60,000 normal selling price. So what will be the solution in here? You add back 60,000 market value and you will minus the 40,000, because the 40,000 cost of sales now after the credit is no longer inside the P&L. Alright? So you will minus. Or instead, you can also just, therefore, the unrealized profit of the 20,000 is add back. Right? Or you can straight away add back the 20,000. Okay, yeah? So far for withdrawal is okay? Alright. Now class, next part is actually got one more part to go only for this chapter. Foreign exchange gain or loss. Right, this one I will discuss with you in the next class. Right, before we end this, I show you the answer for your chapter 2. Okay? Okay, check your question 1 and 4. Now, and at the same time, show me the homework. Alright, you can just check the answer. Alright, I will just go through. This one is question 1. Alright. Okay, then look at question 4. Now, because actually question 4 have many many previous year in here, right? So that's why I just asked you to based on the rules in 2018. Because why? 2012 and 2014 and before, actually the rules is different. Just assume that we are using the same rules. Okay? So this is for your question 4 answer. Yep. Alright, continue 7 and 8. Okay, a lot of you don't know the question 9 here. Okay, let's start. Yes. Okay, continue 8B. question first. So I didn't show you answer here. You go back and try again. Okay? So let's see the question. Alright, because a lot of you didn't do your part B, yeah? So let's see the question again. Now, first of all, class, part A, no issue, right? Okay, part B. I want you to amend a question for me, right? Do one more year for me. Supposingly, your question is it compute the total income up to 2017? Alright, please tell me to do one more year, right? 2018. Okay, up to 2018. Alright, and then class, actually how are you going to do this? They ask you to compute the total income, correct? So you must highlight this one now. They actually want total income. And how you get total income is not just add up like this, yeah? Shh, listen first. Okay? It's just not add up like this, right? You must refer back to your chargeable income format. Okay? Now class, if you go to your chargeable income format, just now the question, you will determine the adjusted income or loss already, right? Alright, adjusted income. And then now if you look at your format, adjusted income is actually appear in here, right? And now the question needs what? Where is the total income? If you scroll down according to the format, alright, adjusted income, alright, add or minus some charge or allowance, any income that you add on, minus brought forward business loss, right? And then add non-business income, blah blah blah. Alright, can you see there is a total income here? This is the question required. Alright, you must calculate this total income. But of course, in your question 9, a lot of information is not given. Basically, it's only adjusted income and the loss. Okay, so now they actually test you how you utilize the losses. You get what I mean? Alright, so please go into this format. Calculate up to your total income for every year up to 2018. So now can you get the idea? Alright, please try first and only I share you the answer next week. Okay? Thursday I see you, right? Thursday I show you. Okay? A answer you do it first. Because A and B answer is linked. I will show you together. Alright? So far no homework today, but just please complete this question 9. Okay? Just do one more for 2018.